You've been told that $1 million is the gold standard for retirement. But in the current economy, $1 million is just a slow-motion recipe for going broke. Let me show you the cold physics of why your number could actually be wrong. Welcome to Silver Fox Insights, where we simplify investing, markets, and wealth building with clarity, not complexity, and understanding before action. In our last session, we tore down the universal retirement myths. We looked at the reality that the old assumptions are broken. True financial freedom is about reducing dependence rather than chasing a massive savings target to impress strangers. But realizing that spending habits matter more than a static number leads to a much deeper problem. If the old rules of the game no longer fully apply, what is the actual transparent framework you use to build a sustainable future? If that question makes you hesitate, don't judge yourself. In my 30 years in the markets, I've learned that hesitation and patience isn't a bad thing. It's just experience speaking. It means you've lived through enough market cycles to know better. This brings us to the core of the issue. If we want a framework that actually holds up under pressure, we have to stop guessing and look at the cold, hard calculation of capital preservation. The financial industry loves nice, round, psychological milestones like $1 million. But $1 million today doesn't buy what it did a decade ago, and it certainly won't buy what you need a decade from now. So the real question we need to ask ourselves is remarkably simple. Are we building a bridge to freedom, or are we funding a silent catastrophe? Whether you are 35 and starting to build, or 65 and looking at the exit, the math remains exactly the same. To understand why the old framework failed, we have to look at why this moment is a great reset. For 30 years, the global economy enjoyed the Great Moderation, an era of low inflation, falling interest rates, and cheap global labor. Take a moment to let that sink in, because that 30-year anomaly is probably over. A common misconception I see all the time, even among sophisticated professionals, is the belief that future investment returns will magically rescue current overspending. It's an easy trap to fall into when you've been conditioned by a decade of easy money. But we are moving out of that disinflationary safety net and into a period of structural inflation. When the cost of core necessities compounds at 4 or 5% instead of 2%, your retirement framework isn't a static target anymore. It's a moving one. If your entire future is built on the assumption of a flawless 8% market return every single year without fail, you are mistaken. This new era demands we account for reality, not historical averages. So, where do we actually start? Most people begin their framework backwards. They start with a total net worth goal. But the math tells us you should start with your core burn rate. Over 3 decades in the international markets, I've seen millionaires go broke and modest savers retire in absolute luxury. The difference was never the size of the initial pile. It was their understanding of fixed versus variable friction. This is where a principle I've leaned on for decades applies. You cannot control the wind, but you can absolutely control your sails. Your core burn rate is the absolute minimum capital required to keep your lights on, your family fed, and your taxes paid. In this environment, you must stress test this number. A way to do this is to take your current annual expenses and add 20%. Why 20%? Because lifestyle creep is a choice, but cost creep is an inevitability. If you cannot cover this survival floor using a highly conservative yield, then you don't have a retirement plan. You have a running out of money plan. But the framework shouldn't treat everyone the same. The math changes dramatically based on your distance to the exit. And as I migrate this channel to help those of you over 30, we need to look at these disparities clearly. For the accumulator under 45, your framework is entirely about the quantity of units. You shouldn't care about the daily price of the index. You should care about how many shares you can vacuum up while prices are reasonable. Your framework must account for decades of currency debasement. If you think you need $1 million today, inflation math says you actually need closer to 2.8 million to hold the same purchasing power by the time you retire. For the transitioner between 50 and 60, you are in the structural danger zone. Your math is no longer about aggressive growth. It's about sensitivity to the sequence of returns. A 20% market drop for you right now is mathematically 5 times more damaging than it is to a 30-year-old. Your framework requires a dedicated buffer layer, 2 years of cash or cash equivalents, completely isolated from the stock market. And for the preserver over 65, your framework is purely about yield versus inflation. The dangerous assumption here is looking only at a stable account balance. If your portfolio yields 4%, but structural inflation is running at 4.5%, you are quietly getting poorer every single day, even if the face value of your account looks safe. This brings us to a truth that hits uncomfortable ground. You've seen the popular videos cluttering your feed. How to retire on $500,000 in paradise. How to make 20% a month in crypto. Having lectured at master's level in financial disciplines and worked the floors of international markets, I have an obligation to be direct with you. That isn't investing. It's financial gambling. So the real question becomes, why do we let the noise dictate our future? Influencers build frameworks around the best-case scenario. Professional risk management builds frameworks around the worst-case scenario. A realistic plan accounts for rising taxes, periods of flat market growth, and stretched social systems. If your retirement relies on a perfect market or a government safety net to save you, you haven't built a portfolio. You've built a hope chest. To break out of that trap, a sustainable framework must satisfy 3 distinct, unyielding pillars. Pillar 1 is the liquidity ratio. Do you have 12 to 24 months of your core burn rate in assets that cannot lose nominal value? This is your sleep-at-night fund. In a shifting economy, cash isn't trash. It represents structural optionality. Pillar 2 is the income floor. What percentage of your basic needs are met by non-correlated income? I'm talking about dividends, rental income, or fixed yields. If you rely on selling equities into a volatile market, you aren't free. You are a slave to the market's mood swings. Pillar 3 is the growth engine. Even in retirement, you need an inflation-fighting component. You need assets, be they deep value stocks, specialized ETFs, or a highly controlled slice of digital assets that consistently outpace the eroding power of inflation. Look closely at where you stand right now. Many people have a lifestyle risk problem disguised as a market problem. In the era of easy money, we were conditioned to spend based on our paper wealth rather than our actual cash flow. Your house went up, so you felt rich. Your portfolio ticked green, so you increased your consumption. But in a structural inflation environment, your net worth can stay flat while the real-world cost of electricity, insurance, and healthcare doubles. Take a moment to think about that. If you are asset-rich but cash flow poor, you are exposed. If you are drawing down more than 3% of your total portfolio right now, you are mathematically eating your seed corn. Build on these 3 pillars to facilitate ensuring your financial future remains stable and resilient against the shifting tides of the economy. Do yourself a favor this week. Take a look at your last 3 months of bank statements. Subtract the ego. Subtract the things bought to impress people you don't even like. What is left? That is your true cost of existence. Multiply that by 25, and you have your survival number. Multiply it by 33, and you have your safety number. If you aren't at that survival number yet, it isn't a sign of failure. It's just a clear signal that it's time to refocus. I didn't spend 30 years in the markets and a decade lecturing to tell you what you want to hear. I'm here to tell you what the math says, because the shift from growth to value isn't just a portfolio strategy. It's a lifestyle strategy. It's about moving your life from fragile to anti-fragile. Now we've run the numbers today, and for some of you, that math might feel incredibly daunting. You might be looking at a shortfall that feels impossible to bridge, or feeling like you've started too late. But let me give you perspective from someone who has made mistakes and seen every kind of market cycle. Math is not a sentence of doom. It is just an engineering problem. A shortfall isn't a dead end. It's just a clear indicator that you need a different set of tools. If you feel behind, you aren't locked out of a secure future. You just need to abandon conventional strategies that were never designed for speed. In our next session, we are turning away from the anxiety of the numbers and looking directly at the solution. A 10-year emergency rescue plan. I'm going to show you how we can compress decades of conventional wealth building into 120 months of tactical, structured execution. The door isn't closed. It is just time to change your strategy. This is Silver Fox Insights, where smart investing starts with patience, discipline, and perspective. Till next time, a vulture is a patient bird.